Hi, welcome to Five Things Finance. I'm Charles Phillips. Please like, subscribe, and share this video on your Facebook story. Today we're going to talk about 5 factors impacting and affecting your credit score. So we're going to talk about payment history, credit usage, total balances, and last but not least, credit checks/available credit. Okay, let's talk about payment history. Payment history, which is your repayment pattern, that is the number one factor that impacts your credit score. So these are the habits that you've built around paying your credit balances down or making payments on your credit cards. So clearly, a late payment or late payments negatively impact your credit score. So the more late payments you do, the more negative this factor is going to be and going to impact your credit score. Now, the opposite is also true. The more often you pay on time, or the less amount of times you pay late, the better this will impact your credit score. So it's very important to at least pay the minimum. However, you should pay more. You should always, 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 always strive to pay more than the minimum. And you need to always pay before the due date. So something that you could do with a lot of the credit cards now is based upon when you know you're going to get your payment from your work, you can schedule your credit card payments to, like, let's say for example you get paid twice a month. You could schedule every month based on your cash flow situation what day of the month you want your credit card to bill your bank. And so that'll get you in the habit of paying on time. And if you feel like you don't know if you're going to have enough to pay more, well, you determine what that amount's going to be as you set up your automatic payment process. Credit history. Credit history is the length of time that you've had credit. So if you got your first credit card when you were 18 and you're 28 years old today, your credit history is 10 years. And you can do the math based upon when you got your first credit, either it was a car loan or a credit card, whatever it may be, and you just subtract how old you are from the age you were when you got your first credit amount. That tells you what your credit history is. So with this factor being the second most important factor on your credit score, the longer you've had credit, the more positive this factor would impact your score. Now, why is that? Well, let's just be reminded on what the credit score is measuring. The credit score is measuring how risky of a borrower you are. In other words, what's the likelihood that you are going to pay back this loan, which is what credit is? What's the likelihood you're going to pay this back in full on time? And so the longer you've had credit, the longer the credit card companies have had to see your habits. And so if those habits are good habits, naturally, your credit score is going to be favorable. But if those habits are bad habits, then your credit score is not going to be favorable, be unfavorable, right? So if you've got 10 years of late payments, well, guess what? Your credit score is going to be low. If you've got 10 years of all on-time payments, never been late, not once, your credit score is going to be higher, relatively speaking. Now, I put this last bullet in for parents. I just recently learned this. There are some credit cards out there that will allow you to put your children as a card holder on that account. Now, what does that mean? Now, however old they are now, that's when their credit starts building. Now, if you do this, you have a huge, huge, huge responsibility because you need to pay those cards on time. because not only are you impacting your credit score, but you're also impacting the future opportunity for your children to borrow their credit score. So you got to be very wise with this if you're going to do it. I'd only do it if you have the great habits of paying on time, keeping your balances low, or maybe not even using the cards extensively. But it's just something to think about as a factor impacting credit scores. Credit usage. Now, credit usage is the amount of your credit that you are using as a percentage of the total available credit you have. So, for example, if you have, let's just be simple, $1,000 of credit and you've charged $100, then your credit usage is 10%, right? Because 100 divided by 1,000 is 10%. So as you look at the amount of credit that you have available to you, and you look at the amount of credit that you've used, you can calculate your credit usage. And as we refer back to the whole point of the credit score, which is the measure of the likelihood that you will repay your loan, or in this case, your credit, in full in a timely manner, the credit companies would prefer for you to have a lower credit usage percentage for a positive impact on your credit score, right? So if you're only using 10% of your credit versus someone who's using 99% of their credit, the belief is that the individual using the 99% of their credit is a higher risk of repayment than someone who's only using 10% or 5%. So the credit usage is an important factor of your credit score, and it's looking at what percentage of the total credit available to you are you using. And ideally, they'd like to see less than 10%. Total balances. Now, total balances are exactly what you would imagine them to be. It just totals all of the balances that you have on all of the credit cards and all of the loans that you have outstanding. So the higher your total balance is, the higher the likelihood that you are risky, that you're a risky borrower. The lower your balance is, the more positive impact this factor is going to have on your credit score. Now, obviously, the purpose of credit is to use it, but it's to use it wisely and to be a responsible user of that credit. And so we are at the fourth, just if you were keeping count, the fourth factor, and we did these in order of how much impact they have on your credit score. So total balances, while they do impact your credit score, it's not as strong of an impact as the other three that we've just talked about. But that is what is another factor on your credit score. Credit checks and available credit. Now, I've bundled both of these together because together, these two factors have around, well, less than 10% of an impact on your credit score. However, they're still important, right? So they still need to be looked at. So when you look at a credit check, it's when you're going to get a loan, you're going to get a car, you're going to get a house, they got to check your credit. Or if you want to increase how much credit you have, they're going to have to check your credit. There's certain reasons why they have to check your credit. And so there are these like official credit checks, and then there's kind of unofficial, like if you're searching for a loan on a house and you check 5 banks at the same time, that doesn't have the same impact as if you check 2 banks in January, two more banks in February, and two more banks in March, right? When they're bundled together in a short period of time, they don't have as much of a negative impact on you as if you had them spread out. Um, and then available credit is exactly what you would assume it to be. It's how much credit is left over from the total credit that's available to you. Subtract the balances that you had. So if you look at your credit limits and you add them all up, you look at your balances and you add them all up. When you subtract your balances from your total credit limits, that gives you what's left over, and that's your available credit. So again, these two factors, I would say, in a lot of times, you hear people talking about credit checks and available credit more than some of these other factors. While they are important, they are the lowest impact. They have the lowest impact on your credit score as it compares to the previous four factors that we've talked about. Thank you so much for watching Five Things Finance. I hope you learned a lot. Today we talked about factors impacting your credit score, and now you have the tools and the information to go check your credit score, see how those factors are affecting you specifically, and then take actions to fix those problems or to improve your credit score by addressing the issues that your credit situation is dealing with. Come back soon for more. You will continue to learn and enjoy. Please invite all of your friends, family, and business colleagues. Like and subscribe. Thank you so much.